We've seen a wave of private equity-backed companies hitting the wall. In September 2025, the subprime auto lender Tricolor Holding filed for Chapter 7 bankruptcy, a move that liquidated a company under a cloud of fraud investigations. Its collapse stranded thousands of borrowers and rattled its big-name lenders with its asset-backed securities, plummeting to as low as 12 cents on the dollar. Just weeks later, First Brands Group, a major auto parts maker, also filed for Chapter 11 bankruptcy, revealing over $10 billion in liabilities and sparking a federal investigation into allegation of fraud, including up to $2.3 billion in missing assets. The company allegedly pledged the same invoices as collateral to multiple different lenders. These aren't isolated incidents, they are part of a disturbing pattern. In 2024, a record 110 US companies backed by private equity filed for bankruptcy, the highest number since tracking began in 2010. These firms are often the product of a strategy that Wall Street has fallen in love with: buy up smaller successful businesses, stitch them together into a national giant, load them up with debt and extract value. But now the foundation is rotting. The aggressive acquisition strategies were financed with enormous amounts of debt. As interest rates climbed, the cost of servicing that debt became unbearable. The cash flow these private equity models depend on began to dry up. The entire house of cards built on cheap money and aggressive growth is collapsing. And who are the unsecured creditors in situations like this? They are the supplier who provide materials on credit. They are the employees owed their final paycheck, and tragically they are the customers who put down massive deposits for products and services they will never receive. Their money is just gone. This is the human cost of all this, but the financial story, that's where it gets even worse, because this isn't just about a private equity deal's gone bad. The debt that fueled this spectacular rise and fall is a key part of the booming and incredibly risky world of private credit. The debt that sinks companies like Tricolor often ensnares the biggest names in finance, including giants like JP Morgan Chase and BlackRock. BlackRock, the world's largest asset manager, is a dominant player in the private credit space. Recently, a collateralized loan obligation CLO they managed, named BlackRock Baker CLO 2021-1, repeatedly failed key health checks due to the deteriorating quality of the loans inside it. This forced BlackRock to take a rare step of waiving management fees, a clear signal of distress. But how can an investment that seems fine one day become so troubled the next? Welcome to the world of private credit. This is a term you're going to hear a lot more about. It's the hidden engine of the corporate world, a vast murky shadow banking system. After the 2008 financial crisis, new regulations made traditional banks safer by forcing them to take fewer risks. So when a mid-sized company, especially one owned by a private equity firm, needed a loan, banks were often no longer interested. Wall Street abhors missed an opportunity. A new industry led by asset managers like BlackRock, Apollo, and KKR exploded to fill the gap. They stepped in to become the new lenders, operating outside the strict regulations that govern banks. The result has been an explosion. The private credit market has ballooned into a global behemoth, estimated to be worth between $1.7 trillion and $3 trillion, with some projections as high as $8 trillion in the coming years. It has grown so large it now rivals traditional loan and bond markets. But this explosive growth comes with a dark side. The three great dangers of private credit are opacity, liquidity, and contagion. So first is opacity. The private in private credit means just that. These are not public loans. Their terms aren't disclosed. The lenders get to mark their own homework, valuing the loans based on their own internal models. This lack of transparency means a loan can be presented as a perfectly safe even as the borrower is circling the drain, hiding the rot for months until the lender is suddenly forced to admit the truth. Second, liquidity. You can't easily sell a private loan. Once a fund makes a loan, they are generally stuck with it until it's paid back or it defaults. This creates a huge potential problem. Many private credit funds now offer products to everyday retail investors, promising them the ability to get their money out periodically. But the fund themselves is holding completely illiquid assets. What happens if a wave of investors gets spooked by defaults like Tricolor and First Brands and ask for their money back at the same time? Well, that's a classic bank run scenario, but in a completely unregulated environment. And third is contagion. The defenders of private credit say it's safer than the banking system, but this ignores a critical dangerous connection. Private credit funds themselves borrow money from traditional banks. They use massive credit lines from bank to leverage up their returns. This creates a hidden indirect exposure for the entire banking system. A problem in the shadow market could suddenly become a massive liquidity crunch for the real banking system the post-2008 regulations were designed to protect. The financial world is more interconnected and opaque than ever before. Understanding this hidden risk is the first step to protecting yourself. If you want to get ahead of the curve and understand the forces that are really moving the market, you should consider subscribing and liking this video. The collapse of the First Brands and Tricolor are not isolated events. They are the canaries in the coal mine. They are warning signs of a much larger systemic problem festering in the heart of corporate America. The direct result of a decade of cheap money and a reckless hunt for yield that has left thousands of companies dangerously over-leveraged. For the past 15 years, corporations have been on an unprecedented borrowing binge. The global stock of corporate bond debt reached an astonishing $35 trillion by the end of 2024 in OECD countries. The government debt to GDP ratio is predicted to hit 85% in 2025, nearly double its level before the 2008 crisis. This mountain of debt was manageable when interest rates were near zero. That era is over. The cost of carrying this debt has skyrocketed. This is the macro environment in which the private credit time bomb is set to detonate. The borrowers in the private credit market are typically smaller, weaker, and more leveraged than their public counterparts. They are the most vulnerable to rising interest rates and economic slowdown. And we are already seeing the stress. The use of the so-called payment in kind or PIK loans is on the rise. This is a desperate measure where a company is unable to afford its interest payments in cash. Instead, it pays with more debt, essentially taking out a new loan to pay the interest on its old one. It's a classic strategy to extend and pretend, masking the true level of distress in a portfolio until it's too late. Some experts, particularly those with a vested interest, will insist there is no systemic risk. They will claim these are just isolated incidents, but we've heard this story before. In 2007, officials told us the subprime mortgage problem was contained. They were catastrophically wrong. The parallels between today's private credit market and the pre-2008 subprime mortgage market are undeniable and deeply unsettling. Both involve the packaging of risky debt into opaque products. Both feature a breakdown in underwriting standards fueled by a frantic search for higher returns. Both rely on flawed models and conflicted valuations, and most importantly, both feature a hidden, poorly understood web of connections that can turn a localized problem into a global systemic crisis. The crisis is likely to unfold in waves. The first wave is already here, a surge in corporate defaults, starting with the most vulnerable private equity-owned companies. The second wave will be the crisis in the private credit funds themselves. As defaults mount, these funds will be forced to mark down the value of their loan portfolios, triggering losses for their investors, which now include pension funds, insurance companies, and everyday retail investors. This could trigger a crisis of confidence and a rush for the exits, leading to a liquidity crunch we discussed earlier. The third and most dangerous wave is contagion to the core of the banking system. As private credit funds rush to draw out their credit lines, it will put immense strain on the bank's own balance sheets, potentially freezing credit markets for everyone. This is how a corporate debt crisis becomes a full-blown financial crisis. A shock that began with a troubled car lender could ripple outwards, impacting jobs, savings, and investments around the world. The belief that risk could be perfectly managed, priced, and contained in this opaque corner of the financial world is now being put to the ultimate test, and it is failing. We are facing a corporate debt crisis that has been years in the making. The combination of record debt levels, stubbornly high interest rates, and a slowing economy is creating a toxic cocktail for thousands of businesses. This is no longer a theoretical risk, it's happening right now. The defaults are accelerating. The question is no longer if the bubble will burst, but how bad the damage will be when it does. This isn't about fear-mongering, it's about paying attention to the warning signs flashing red all around us. Thank you for watching, and if you found this analysis valuable, please hit the subscribe button and turn on notification.